Ben, will you tell us something that you believe about real estate that might surprise us?
I believe that it is easier than it's ever been to be able to own single tenant net lease commercial real estate. And it's a great time to do it. And that's what I educate people on a daily basis on how to do that. So let's talk about it.
Welcome to the source of commercial real estate, where we talk to the experts in non residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek. I am a former public school teacher who found financial freedom through residential real estate investing, and now I invest in commercial properties, particularly small industrial. Today, I have the pleasure of talking with Ben Kogut with Rooster Equity. Ben has an extensive history in commercial real estate. He's been a broker, a passive investor, an active investor, and he has experience in nearly every different asset class of real estate. And so this is certainly going to be an interesting and enlightening conversation. Ben, thank you so much for joining me. How are you doing today?
Doing well. Thanks, Jonathan, for having me. I'm excited about the conversation.
Why don't we start with you telling us a little bit more about your background and how you got started in real estate?
Sure. After graduating college in '04, got right into commercial real estate as a broker. Did that until went back to business school in 2011. And then from there, I was inspired to start a development company, a brokerage company, and also investing in commercial real estate. I discovered the world of commercial real estate syndication in 2017. And that's when I pretty much went all in on investing in triple net investment properties and have not looked back. So I personally invested probably in about 45 different passive income triple net deals. And that's what we're doing now with Rooster Equity is we're focused on raising capital and syndicating high quality single tenant net lease industrial, retail, and medical properties around the United States.
All right. So you clarified a little bit there at the end. Single tenant net lease is kind of a broad spectrum. Will you tell us a little bit more about the business plan of Rooster Equity? What kind of deals are you interested in? The lease type, tenant type, location, that kind of stuff.
Yeah, sure. So what drives our investment is a high credit tenant. We're looking for triple B credit or better, which is a fancy way of saying a really high quality, well capitalized tenant that has more than 5 years of lease term remaining. So we know that for the next 5 years, they will continue to be there paying the rent or beyond. Ideally, it's beyond that. And we're looking to acquire these at a discount to what we consider the market prices to be. And we can talk a little bit more about that. And then we can also talk about the asset class. We're looking for tenants who are, let's just say, Amazon proof and recession proof, a hedge against inflation. And ideally, these tenants are on a lease that is an absolute triple net lease or a triple net lease, which means that all the expenses are the responsibility of the tenant. And so we don't necessarily, as a landlord, we don't need to worry about what the taxes, the insurance, or the common area maintenance costs are going to be because ultimately those are passed on to the tenant. And so that makes our predictable cash flows for the foreseeable future a lot easier to calculate. And so we're looking to reduce risk pretty much across the board as much as possible. And we use that, old cliche risk-adjusted returns is really what we are doing, even though it does feel and sound cliche, but that is basically what we're doing.
For sure. Not all deals are created equal in terms of risk. I want to go back to your comments about having a high quality tenant. And you talked about a triple B rating or better. And so I want to ask you about how you vet tenants because these things can change. It was not that long ago that pharmacy tenants were viewed as a high quality tenant. And now some of those pharmacy tenants, some of those pharmacy deals are have carry quite a bit of risk to them. So, talk a little bit more about first of all, what does triple B mean? Where do you find that information? And talk more about vetting the tenant.
Yeah, sure. So there's public information, and that's pretty easy to find. And then there's private information. And so oftentimes we will require that the tenant provide financials. And so we have an analyst in-house that's professional at analyzing these issues. And what I like to focus on in particular are the unit economics, which is a fun way of saying how many widgets does this tenant need to sell in order to be able to break even, to be able to pay the rent that we're relying on, because ultimately that rent revenue is what we use to pay our investors monthly dividends. And so we will get down not only on the corporate level, but also on a unit level. And we can use some AI technology to determine where does that tenant rank in regards to other of the similar tenants in the market, in the local market, or across the region. And so we can determine using AI and some other tools, like how is this tenant going to perform? And then regarding your question of, some tenants that have been closing, yeah, I mean, that is certainly a risk that is occurring. We have to look really closely at what are the trends in the market, what's going on a macro level in these particular industries. And so we have a very thorough due diligence process that analyzes all these different aspects of the viability and longevity of a tenant, because ultimately we are ultimately buying real estate, but we're really buying a lease. And so that lease is what we're banking on. And so we have to make sure, to the best of our ability, that that tenant, aka that lease, is going to remain intact for the foreseeable future.
In terms of unit economics, it would be great if every lease required the tenant to disclose financials. But unfortunately, as you know, that's not always the case. And we might love a particular property or a particular tenant or location, but we just don't know that granular information. Is that where some of the AI that you discussed, whether it's using Placer or some of the other tools, demographic data, can at least get you close and get you comfortable with, we feel really good about how this tenant is probably performing without having the actual financials in front of us?
Yes, I'm glad you mentioned Placer. That is one of my favorite tools, using cell phone technology to determine how often and how long people are visiting certain locations. It used to be before AI and all this technology, I would literally go sit in front of the property and watch the traffic, watch, how many people are there. And so, these are the types of things, having conversations, talking to the manager, secret shopping, talking to, really just talking to people to find out what is the reality of what's going on within the business as well as within the area. And so, that is a big part of our due diligence process. Is you'd be surprised at how much you learn just by merely talking and asking questions. So that is a super important part of the DD process.
You had talked about being especially interested in tenants that are Amazon proof. Will you talk a little bit more about, are there certain tenants, certain asset classes, or asset types that make you feel good that is probably not going to be taken over by Amazon or a competitor?
Yeah, I think a lot of people used to think that, quote unquote, retail is dead. And obviously the secret of Amazon is out. We know that. And so when you look at a shopping center as an example, it's not necessarily where people go shopping. And I'm excluding big malls. I think that's a different category than what we deal with. And so shopping centers, I think, maybe should be rebranded as maybe like lifestyle centers or service centers, which service center also has a different connotation. So I don't know. We're kind of working on the branding of what a shopping center in today's day and age should look like. But Amazon proof are, things like a dentist, or we just acquired a collision repair place. And even if every single car on the road was to all of a sudden be self-driving Tesla vehicles, Well, that would be interesting and pretty cool, but I don't think that's going to happen in our lifetime. I think people are still going to be driving vehicles, and there's still, unfortunately, going to be collisions. And so we would consider that to be an Amazon-proof business. Restaurants, as an example, people still want that experience of going out and being around other people and the service and all that other kind of stuff. So these are just little examples of, businesses that we believe will have lasting impact in the community, and we love to invest in projects that really build that community. It's super important.
You're so right in that these shopping centers that well, shopping center is kind of an outdated term because you can now go to a shopping center or strip mall and there's a grocery store, but there's also a QSR, and then there's a tire change place, and then a car wash, and a dentist out parcel. And so all of these things that used to be compartmentalized, like you'd go to the dentist at that ugly drab medical office building, and you used to get tires in the industrial park, back on the outskirts of town. Now a lot of those things are in the same location. Is that kind of what you're talking about with some of the properties you're interested in?
Yeah, exactly. Yeah, these prime locations where people are showing up on a daily basis to either they're working there or they're there as a customer. And I'm here in Austin, Texas, and 97% of that space is occupied, which is extremely high and in demand. And so that's what we're doing is we're investing in these types of in-demand properties that used to be owned by a lot more just individuals, either just people that were individually investing, high net worth people. And so now what we're doing is we're creating opportunities for smaller individuals for as little as $100,000 to be able to own a piece of these projects that they wouldn't normally be able to afford on their own.
You mentioned earlier that you are buying at a discount, and I love a discount as well. And so I want to ask you about this, and I want to ask you about it connected to the lease term, because the price of an asset can be closely related to the type of lease that they have. And so I know you've closed deals with quite a bit of lease term on them, like 15 years or more, I believe. And then you also mentioned that you'll entertain deals with maybe only 5 years left on the lease. So, will you talk me through how you view pricing these assets and what a discount means to you and how you go about getting that discount?
Sure. So one of our proprietary methods is we know what we're looking for. And so we have an analyst who is making offers. I would say those are the reduced price offers. We're making aggressive offers, I'll put it that way, on assets. And so we look at probably five to 600 deals per week. And so out of that, we'll make offers. We'll probably have maybe 5 to 10 deals that really fit in what we're looking for. And so we're making 5 to 10 offers a week on properties, and we're looking for sellers who are motivated to sell at a discount. And so it's really just a funnel, just, as we're looking to just make a lot of offers and some of them stick. And when they do stick, then we're quick to make an offer, but we're slow once we put it under contract to go through our due diligence process and make sure that everything is what we think it is. And so I think that really is one great way to be competitive in today's market because, there's a lot of competition for these things. And so what we try to do is just be there first. So within 24 hours of something hitting the market, typically we'll send a PSA, a signed contract, as opposed to what I think a lot of people in the industry do is to send a letter of intent. And so we effectively show them that we're serious. Like let's get down to business. Here's the PSA. Here's a list of references. These are people that will basically you can call them and they're going to tell you, hey, at Rooster Equity and Ben Kogut, we do what we say we're going to do. And that's how we do business. And then we promise them that within 2 weeks of being under contract, we're personally going to be on site to visit the property. And then, like I was saying, we just do what we say we're going to do. And that has been a really I wouldn't say a secret, but it's been a recipe for success is making a lot of offers.
You mentioned that you're often making offers within 24 hours of the property being listed. Is there anything that you're looking for specifically in the offering memorandum, in the Crexy listing, that jumps out to you that says, oh, there might be some distress here? This seller might be looking to sell pretty quick. What jumps out to you that makes you think, okay, this one's going to be worth pursuing?
That's a great question. So, since we're so familiar with where cap rates are on certain asset classes, we can tell pretty quickly whether or not something came on the market at a price that might be a little higher than what we think it should be worth. And so that usually raises a yellow flag where it's like, okay, well, maybe there's a motivated seller here for some reason. I mean, and the reasons can it's a spectrum. What from someone that just inherited it, or there's divorce, or who knows? A lot of million reasons that are motivated sellers that are unrelated to the asset. And so, as soon as we have a yellow flag trigger because something is priced in a way that we don't think is in line with the market, we'll likely make an offer on it and see if, in fact, there is a motivation beyond what we might see on the Crexy listing. And then you start talking to the broker or to the sellers themselves, and you can start learning a lot more about what someone's motivation is.
And sometimes brokers slip up. Sometimes brokers divulge some information, and brokers don't always know all the motivations of the seller, but sometimes they do. And sometimes, if there's some distress or they're in a hurry to close, sometimes a broker will divulge that information, and that can be really helpful information on the buy side.
A thousand percent. Just having these conversations, asking questions, as simple as, why is the seller selling? And then they start blabbing, and you're like, oh, okay. And then, try to find a way to, make some lemonade out of that situation, whatever it is.
And when you talk about discounts, are you valuing properties based on a cap rate, based on price per square foot, based on the path of development? What does a discount mean to you, and
Uh,
how are you valuing that?
Yeah, so it's a tough question to give you an answer on a short period of time, but you hit on the key points. Yeah, the cap rate, the tenant, the lease terms. Maybe there is a path to adding value somehow. Like for example, we recently acquired a property. It's a single tenant property. The tenant had 6 months remaining on the lease. Well, we knew because of a relationship we have with that particular tenant that they were ready to commit to that location for an additional 15 years. Well, the seller didn't know that. They were not talking to their tenant. And so the seller thought, well, I'm about to lose a tenant in 6 months and be stuck with an empty building. And so, with that knowledge, we put the property under contract. And while we're under contract, we were able to successfully negotiate a 15-year lease extension with the tenant. And before closing, the seller thinks we're buying a 6 month deal, and we know we're buying a 15-year deal, which really mitigates the risk. I mean, I'm not going to say there's no risk because there's always some sort of risk, but with a credit tenant with a 15-year lease, it's guaranteed. Um, Hard to say that there's really any risk at all, to be honest. So those are the types of scenarios where we're looking for that was a motivated seller. They did not want to be stuck with an empty building. And so that gives us the opportunity to find those properties at a discount. And then on top of that, to answer your question, yes, of course, is this lease above market, below market, or right at market? If it's an above market lease, we're probably going to have to discount it in our underwriting to make sure that we can make up for that. Versus if it's a below market lease, it actually gives us the opportunity whenever the lease expires, whenever their options expire, that gives us an opportunity to negotiate and lock in some better rates, which is also another strategy that we use.
The scenario that you just outlined is the ideal scenario. That is my buy box. I love expiring leases. I love below market rents with high quality building, a great tenant that wants to stay. How common is it for you to be able to find deals like that? 6 months left on a lease and the tenant wants to stay.
We, we get a couple of them a year. I mean, we're on track to do a deal every 2 to 3 months. So, five, six deals a year, that kind of thing. And they all are a little different in their own way, but we generally have a path to adding value in some way, whether it be what I was just describing, or perhaps the buyer or the tenant need they need something. And you find that out by having these conversations. Maybe the seller was not capitalized to provide tenant improvement allowance to fix whatever needs to be fixed. And so that is part of our model. We'll come in and provide that and perhaps amortize it into a lease, or somehow we'll capitalize on it, but we can provide capital in a way that perhaps an existing landlord might not be able to. And so the little ways like that can really go a long way in an investment property.
Will you talk more about any other creative ways to add value? It seems like that is really your secret sauce, is digging into the details of a deal that maybe an unsophisticated seller is not aware of and figuring out how you can add value. I know you've been a part of some deals recently where there's been like a huge rent bump randomly in the lease, and you were about to take over possession of the property, and then you're going to capitalize on this huge rent bump. Are there, things like that, or any other sneaky ways to add value to net lease deals?
Yeah, sure. So that example is the tenant sold their business to a national credit tenant, and then kept the real estate. And then a few years later, we come along, we want to buy the real estate. They're ready to sell the real estate. And they had already negotiated a 15% rent increase. And so that is to our significant benefit. And so we'll ride that wave, so to speak, watch the rent increase over the next couple of years in a very meaningful way. And then at that point, we'll have a couple options. We can continue to own it. We can sell it at that point at a much higher rent, or we can actually go to the tenant and negotiate a blend and extend. In other words, a way to add more term on the lease and give them some sort of favorable economics in exchange for that. So the blend and extend strategy, we didn't invent it. It's definitely a very popular way to do it. But I think what we're doing that I just don't see as many people doing, and this is why we're growing pretty fast at Rooster Equity, is just, I think most people that are raising capital and investing in properties, that a lot of them have been doing multifamily. And so we make it a point not to do multifamily or any residential whatsoever. And so we are structuring our deals to be able to pay monthly dividends to our investors, and making it as accessible as $100,000 to get into a project. And so I think that is, and we're also doing a price point that's on the acquisition that's usually higher than what an individual would want, but lower than what the big private equity money would want to pursue. So we've kind of found this niche sort of in that middle zone, and that has been a great place for us to be. And then I'll add one more thing, which is frankly, we're seeing a lot of need for equity to go into build to suit opportunities. And so these are situations where, like, let's say, for example, I'm working on a Chipotle deal as an example. Chipotle freestanding buildings, they we have a property. They've identified that they want to open up shop there, and so they will provide us with a lease, and then our team will build them a single tenant building that they will occupy for at least 15 years. And you can I don't want to get into all the details, but they're profitable business ventures. And so I'm finding that now that we're doing that, there's a lot of developers out there who have these tenant relationships that want to build these single tenant net lease projects they just don't have the time, the effort, or the network to raise the private equity that you need to be able to get these over the hump. And so that is another division here at Rooster Equity, is raising capital from private accredited investors, and then providing that as equity into build-to-suit projects. And one of the big differences as an investor, are you somebody that is looking for monthly passive income right away, which is what our model typically is, or are you somebody that is okay with putting money into a project and not seeing a return for 18 to 24 months, something like that, because it takes that much time to get the project up and running and then exited. And so they're just like different strategies, but they're similar but different, that kind of thing.
As you were talking, it got me thinking about different strategies within the single tenant net lease space. And a lot of people think of single tenant properties being ideal for 1031 buyers, people that have just exited, like you said, a multifamily property or maybe a business or some sort of other investment. They've got a chunk of money and they want mailbox money. And so they're looking for a single tenant deal, a dialysis center or a In-N-Out burger or a Wendy's or something like that. And they just want mailbox money. And so it's kind of interesting. I love single tenant properties as well. I focus on just industrial properties. But it's interesting that the deals that, these sort of hairy value add deals that you're talking about are not ideal for 1031 buyers, because 1031 buyers are good just buying a 6.5 cap and getting that ACH payment every month and not having to deal with anything. But you are not stopping at just buying a 6.5 cap and doing nothing else for 15 years. You're buying some hairy deals. So can you talk a little bit about kind of the difference between what you are doing in your business model versus the classic 1031 mailbox money buyer?
Well, first of all, we're not buying a 6.5 cap, so we have to buy better than an 8 cap for anything in
Okay.
our model to work. But I would say that there are similarities. I mean, somebody that was in a residential property that they were fully managing, and all the fun that comes with toilets and all that kind of stuff. And so this is their opportunity to, maybe be in a different phase of their life where they just want to get out of management and just sit in a passive position. What I think is also not talked about enough is how somebody can 1031 as a tenant in common into a project. And so maybe they, similarly, same goals, but they have, not enough money to 1031 and own the whole thing. Well, we can create it's called a tenant in common. And basically they come in as a partner of the partnership. And so I'm not a lawyer, nor do I pretend to be one, but the lawyers have figured out how to do that, and in a way that is kosher in the eyes of the law. And so, because there's a lot of legalities around 1031, and of course timing is really, really, really important when it comes to 1031, because you have such a short fuse to be able to identify and then close after you have exited whatever your property was. And so we figured out a way to continue to help people at various sizes, but they also lean on us for our analytical skills and our ability to find deals that may or may not be on the market. And so that's how we add value for them, is that they can rely on us, and they can invest either a part or all of their 1031 money alongside us into a variety of different projects.
You talked earlier about viewing risk and risk-adjusted return. So, on that note, kind of transitioning from the 1031, looking for something with reduced risk and more passive. Will you talk about how you view risk in this asset class?
Oh, great question. Yeah, I mean, risk is certainly there's the tenant credit risk that we've already talked about, the risk of if the tenant leases, leaves, what kind of lease renewal issues are we going to have to deal with? There's interest rate sensitivities, and if usually we'll have some amount of debt, and so we need to make sure that we have the right debt for the right project. There's other types of liquidity issues. If we have assumptions on what and when we're going to exit the property, there's certainly risk because no one has a crystal ball. We don't know what it's going to look like 2, 3 years from or whenever we project we're going to exit. I mean, the further you go out, the harder it is to determine what that looks like. So, of course, there's these are all types of risks that we do our best to mitigate.
How do you view risk with the types of deals you're doing versus, a typical multifamily syndication that are so common out there? Any thoughts on comparing the two types of investments?
I I don't want to upset people, but I think that I'm very biased. Obviously, that I think the triple net investing is significantly better cap rates. More predictable because all of our expenses are passed through to the tenant. The only thing I don't think is as competitive as multifamily is loans. You can get generally cheaper loans, but then we're also seeing a lot of people getting in trouble because they went for these low interest rates that are variable, and now obviously rates have come up a lot from where they were at the bottom, and we're finding out that a lot of people are in trouble because they can't service the debt.
Will you talk about debt a little bit? What kind of debt terms are you getting on these properties, and where's your debt coming from? Can you walk me through a little bit more about sourcing this debt? Because non recourse in this asset class is pretty uncommon. So let's say you've went under contract on a deal in Tulsa, Oklahoma. How would you go about solidifying debt for a deal like that? What are some of the other requirements or ways to get non recourse debt on these commercial assets? Mhm. I like the way you think. Ben, as we wrap up, you raise money for these deals. Describe passive investor sentiment. Do passive investors understand what you're trying to do with these deals? Finally, if listeners want to connect with you and learn more about Rooster Equity, where would you like to send people? Ben, I really enjoyed this conversation. I really connect with what you're doing in the single tenant net lease space. Thank you so much for joining me today. Listeners, if you enjoyed this conversation, reach out to either one of us. We love talking about commercial real estate and we would love to connect with you. Thank you so much for listening. Until next time.